Hello, everyone. Welcome to special edition of Trade with Conviction. Today, obviously, we woke up on Saturday with the news of attacks on Iran by Israel and the US. And obviously, the situation is deteriorating rapidly in the Middle East. And we thought that it was important for us to get together and provide you with our view of what's happening on the ground with tremendous amount of humility, meaning that things are moving very quickly. We try to stick to the facts. We will be brief today, trying to understand what has happened already, not only in terms of the war itself, but also how has the market reacted. Try to establish a little bit some potential scenarios, but always looking at the next 1 or 2 days, because obviously this is going to be changing constantly, and there's no point at this stage to focus on the long term. Yeah. So today we're joined by Phil, James, June, and Neil. So Neil, let's start with you. What do we know so far? What has happened? And let's take it from there.
Yeah, why don't we start in the most important place, which is shipping activity through the Strait of Hormuz. And as far as we know this morning, it basically emerged as time went on yesterday as well. For practical purposes, the strait is closed. So ships are piling up either side of the straits. Anchors have been dropped, and it appears that very little is flowing through. So for practical purposes, at least as things stand as we talk, not much is flowing. So, I mean, we talked earlier about the pod. At the moment, it's a logistical issue and not a supply issue. But the two are one and the same. The longer this lasts, that's probably a very fair statement, because there's 25 million barrels a day of oil moving through this. So it's one and the same. Now, that's a situation that frequently is said won't be allowed to be maintained by Western powers. And sure, that's very fair. But to be honest, there is a bit of uncertainty about our, inverted commas, ability to keep the straits open, right? So the Iranians look like they're hunkering down. They've changed missile strategies. They're trying to maximize pain in the region, not only in the Strait of Hormuz in terms of shipping, but also infrastructure around the Gulf as well. So I think what we know just now is the thing is basically closed, and there's uncertainty about how long that can last. That is the only statement we can really know just now. June, do you want to go on to talk about tanker attacks maybe?
Yeah, so yesterday we've heard at least 3 attacks on tankers, although reports suggest that some of these might have been false flag attacks. Well, false flag or not, it doesn't matter from an insurance perspective. And we talk about this war risk premium. 7 out of 12 members of the International Group of Protection and Indemnity Clubs, aka the P&I clubs, they will cease cover for war risk entering the AG starting midnight London time on March 5th. Firms that do provide insurance then will charge even higher premiums. But in reality, the costs could get so high that it just makes no economic sense to enter the AG. My view, however, is that oil producers at this point will start facing storage issues, and they will be desperate enough to pay for whatever freight costs, whatever insurance costs to get those barrels out and avoid shutting in production.
Yeah, and we've seen like a build-up of ports that are reportedly shut at the moment. So Jebel Ali in the UAE, due to falling debris, but that's been reopened now, I think. Duqm in Oman, due to actual strikes. And Bahrain, all ports. Here and also Schwab in Kuwait has been evacuated. We've also, kind of coming as a real shock, in the last kind of 30 minutes to an hour, heard about attacks on Novorossiysk in the Black Sea as well by presumably Ukraine. And then a bit more on refineries. So Ras Tanura refinery was this morning shut down after a drone strike. So from a products perspective, it means that we already have evidence of delays to Hormuz and actual supply outages. But it's now less about specific loss in volume and more about the escalation risk from Iran, Israel, US, etc. Iran is dragging other neighboring states into this conflict and attempting to cause pain. Not yet maximum possible pain, but pain nonetheless, particularly this morning and yesterday evening.
Exactly. So if we move on now to what have we seen in pricing and what do we expect from pricing, we can obviously start in freight, where I think it's going to be very difficult to see how that shakes out over the next few days. But undoubtedly, AG freight rates are due to soar today. We've already seen the first reports that March TD3 trading at world scale 330. So on Friday, that was more like just over 100. So whether or not anything actually gets fixed at these levels is another question, but it's at least telling us that, yes, freight rates are likely to do something very unusual over the next few days. If we look outside of the AG, though, we would also expect freight rates to move higher. So we'll likely have to see ton miles in the rest of the legit fleet globally moving higher. We'll talk about kind of a lack of efficiency in the freight market in a second. But I think especially on crude products as well, we're going to see a big grab essentially for loadings outside of the AG. And so this is going to be a chance for ship owners in particular to be the price setters essentially.
Okay, I will now start off by product, which is crude. Brent Dubai EFS is doing as is expected, a jump of about $4 to $5 per barrel from a political premium perspective, and also from the perspective of physical disruption. ICE Murban Dubai also jumped about $3 to $4 per barrel. Again, we talked about it in the pod last week, sharing that Murban has a very strategic location loading outside of the Strait of Hormuz. Dubai is slightly impacted by Platts' suspension of certain assessments in the AG. And obviously, the longer this goes on, the more the Dubai market will technically be cut off, and the Brent Western market will tighten as refiners scramble.
Yeah, and on distillates, we've seen, probably as you'd expect, the gas oil east-west has been widening really hard and pricing closure of the Hormuz Straits. We've seen the same for the HOGO, but of course, narrowing, selling off over the last period of time. Spreads, cracks, up as you expected, in direction of the big short. And jet. Jet, if anything, is reacted more strongly than diesel. So we've seen the jet east-west widening more than diesel. And regrades as well are really kind of historically strong at present.
Is there any reason for that? Shouldn't jet be lower, or the regrade have a negative regrade?
Yeah, well, there was some discussion in our team about that. You know, the closure of airports like Dubai, kind of the effect on jet demand. But I guess actually it's a bigger effect on jet supply, the possible closure of the Straits of Hormuz, and also attacks on AG refineries, because I think it's like something like via the Straits of Hormuz, 20% of global jet moves, whereas compared to like 10% of diesel. And then also if you look at kind of European demand profile, Asian jet or AG jet forms a bigger percentage of it than it does for diesel, for example.
Okay, thanks for that. Yeah.
On the light ends, we would expect from a gasoline perspective this to be bullish for the east-west. And yes, we saw that this morning, that Sing 92 cracks have jumped a lot more than EBOB have. If we look at the April gas east-west, it moved from about -6 to -350 now. We were anyway bullish gasoline east-west for other reasons. So that's at least gone in that direction. And it's a big move, but it's less than what we've seen on naphtha. So naphtha, again, the east-west was already at record highs. We spoke about how this situation was largely driving that. But now that we have seen these attacks, we're up at over $60 a ton in an attempt to kind of overcome that higher freight, and in order to pull from not just the Med, but also Northwest Europe now. So yeah, overall, it's been very bullish for the east-west on naphtha and gasoline, slightly bearish on gas nap.
And Neil, what can you tell us about fuel oil?
Yeah, fuel oil is largely going in the direction you would expect. So the Sing 380 spreads are up. They've jumped into double digits this morning. Cracks are up. The east-west is up $10 a ton, which is not that much perhaps, but there's potentially more to come, of course. And fuel oil, I mean, particularly high sulfur fuel oil, it's going to track a couple of different things. The main one being the direct risk to fuel oil supply out of the AG, plus all the sour crude at risk. And then there's also it's going to be relatively bullish ton miles, right? Possibly that would be the least important thing relative to the potential supply outage, but ton miles are going to go up because the whole crude market, as things stand, is going to be rewiring. Asian refiners are going to be scrambling to try and get crude from the west to the east more and more. So it's generally going to be bullish from that perspective too.
So before we move on to the ARBs and where is the oil going to be landing, and what is the amount of oil that will be landing where, let me just summarize. So what we're seeing right now is that flat price obviously increased significantly when we woke up this morning, perhaps lower than what people were expecting. From the polls I saw over the weekend, it was more like 80 to 90 range. We're struggling to maintain a sort of 80 handle there. From what you're telling me right now, the biggest winner winner. This is not the right expression here, but the market that is by far the most impacted is freight, and we don't know yet what kind of, what is the availability of vessels, if they will be able to cross the Strait of Hormuz, not because of
Indeed
it being blocked by the Iranians, but simply because of insurance policies, because of safety, whether they would like to quote or not. We don't know yet. And I think that market the bid offer spread is probably extremely high, and you don't really have a lot of liquidity going on right now. But definitely it will be the one that has a long lasting impact, because what we're seeing right now is that the market is pricing a logistical constraint, not yet a supply constraint. It will, or it can happen, but right now that is what we're seeing. What I wanted to ask you guys is whether it's naphtha, distillate, fuel oil, etc. Cracks have been going up. Now, at the end of the day, whether if you're a non-physical trader, the way you hedge yourself or you speculate is mostly around crude. So why do you guys think that cracks are going up like that relative to crude?
I'm happy to start. This is essentially what will typically happen when you get this kind of geopolitical risk in the Middle East Gulf. That's a fairly standard response in general. But I think the three prongs to this are: you already have some supply chain disruption in terms of the logistics. You already have one refinery that's been, as far as we know, taken out, so to speak. Ras Tanura has been attacked directly.
Yeah, indeed.
And the implication of that is that Iran is ready to target infrastructure like that, and there's loads of it in the region. So there's direct supply risk from that perspective. And then the third tranche is, if crude is in short supply in the next month, then there may be forced run cuts. And June, I'm perfectly happy to pass to you on that point if you like. But the main gist of the argument is that runs are really at risk in a big way. And if the supply chain is disrupted enough, cracks need to start to reflect that. And cracks also need to start to reflect, or they need to make up for the extra logistical costs. Let's say freight rates soar to $10 per barrel. We need to get crude to the east, and we need to have the crude that's there, it needs to be able to be refined economically. So cracks need to rise to help refineries run.
Which ties with this idea that indeed what we're seeing right now is that, except for Ras Tanura, it's more of a logistical supply chain nightmare rather than a supply itself problem. So, which then obviously has an impact on freight, which has an impact on landed values, which obviously means that the overall price is more expensive and you need to compensate. Okay, so that sort of that makes sense. Yeah. June, sorry.
I wanted to add on. So when this whole thing all started on Saturday, a lot of people were thinking, refineries have buffer. They will just continue running until actually there is a real supply hit. But there is a psychology behind the running of the refineries. If you see something like this happen, your base crude, of which, even like Japan takes 90% of crude coming from the Middle East, you have a potential absolute disruption in the prompt that you cannot resupply from another region. You will start to turn down. That would be the immediate response. You turn down so that you don't have to shut down in the next 15 days.
Interesting.
So that is probably, to me, that's the biggest driver why cracks are performing as how it is today.
Thanks for that. So Neil, we talked a little bit about the jet regrade. Maybe you can tell us a bit more.
Yeah, I'll take that one. Yeah, swinging back to jet regrades a little bit. Yeah, so we've kind of spoke about how they're really remarkably strong at the moment. I mean, I guess we've had differences in the team about whether we expected that or not, but this probably also reflects both Ras Tanura being affected, a big jet exporter, and the initial shock of percentage reduced jet exports out of the AG. Asian demand may increase on flights redirected away from the AG. And also, we've kind of not really moved out of the East Asian, Northeast Asian heating season yet, kerosene demand season yet as well. It's interesting we've kind of seen a little bit of a ceiling found in ice gas oil cracks and spreads, particularly when Europe came in this morning. But we've not seen that same ceiling found in European jet spreads and cracks as well. and the regrades. And I think that's because we need to see European jet pricing do a little bit more to open these ARBs from East Asia, South Korean jet imports into Europe over the next period of time. So maybe that's why there's that difference in the kind of ARB and pricing outlook between jet and diesel as well.
Neil, what can you tell us about crude and what is it worth this morning right now?
Yeah, what's it worth? Tricky to. I mean, one thing is it's going to be very tricky to tell for the moment, right? So we're going to get an update on basically spot premiums, for example, later today. I expect it'll be extremely volatile. You've already seen on the physical Dubai premium rising to something like plus $5-6 per barrel, very high. But there's going to be a lot of difficulty assessing the Dubai market. I think Platts have already stopped assessing certain aspects of it. Murban will be a bit easy. You've got the futures, and we're going to need to wait for this afternoon, it looks, before we get our detailed freight assessments. But what I can say is ARBs are not going to make a lot of sense in the next 1, 2, 3 days. I think what will happen is that, for example, all Brent-linked spot premiums are going to massively rally because you're going to see people scrambling to secure supplies, right? But there's going to be an expectation that crude supply out of the AG is going to be at least disrupted a little bit. So I'm expecting Brent premiums to soar. I'm expecting the ARB that we track to look very out of the money to the east, but it's not going to make any difference, right? It's going to score a 1 or lowest score in our dashboard, and probably the same for WTI. Although I'm noting, if you look at the TI Brent spreads, those are extremely wide as well. So the paper on TI Brent is also looking to help TI to flow.
I don't want to end on that point. So it's all about feasibility versus margins right now. It's just You just need to find oil to fill your refinery, your base load to run to avoid shutting down.
Yeah, agreed.
I think that obviously I'll take up from here and note the caveat on kind of ARBs not necessarily making sense. I did just want to, though, make a little point on naphtha. So we've seen the naphtha east-west go out to over $60 a ton. And despite that, it is still very difficult to make a naphtha ARB work via the Cape because of the amount of backwardation that we've seen coming into MOPJ spreads. So because it takes that little bit longer to get your naphtha from Europe all the way around via the Cape into the east, we will probably need to see that east-west do even maybe a little bit more if we want to see those ARBs in the money. Or, as is perfectly reasonable as well, it may just be that, those flows are going to happen and it's going to be the cash diffs on the other end that make up the rest of it. So yeah, as we said, ARBs don't have to make sense, but if we are looking at them, then yeah, at least on naphtha, the east-west has even more room to run.
Yeah, you mentioned Cape, and that's worth mentioning as well, is that it's the disruption is not only happening in the Strait of Hormuz, but also now again in the Red Sea with the Houthis actively, how would you say this?
Expressing support, expressing the willingness to help.
Yeah, correct. I mean, and obviously disrupting the flow over there too. So we might see as well vessels going through the Cape instead of going through Suez. And that's just going to exacerbate even more freight rates and logistical nightmare. Going back to what you were saying, June, about availability of naphtha, of LPG, of crude in Asian refineries. Moving on to the next steps. Okay, Neil, what are the key critical questions that traders should be asking himself right now? What are the key things that he should be looking at to get a better understanding of what are the next steps?
Yeah, that's fine. I mean, it's not the easiest thing to answer, of course, but I think in the next hours, what we should be looking at is evidence of whether the attacks on infrastructure, and let's just separate this from the shipping issue, whether the attacks on infrastructure are getting worse. So we've had Ras Tanura this morning. I believe there's been a power plant in Kuwait that's been taken out. I think it looks like this morning that infrastructure attacks are on the rise. I've just got a text message saying the port of Novo is out of action. This is a separate thing, obviously, to the Iran story, but I've just got a text unverified, let's say, that Novo is out of action, which would be a huge deal. And I think even if so that's one element. And even if the Strait of Hormuz is reopened, there's the question also on whether the Iranians attack port infrastructure enough, or whether the US administration threatens Karg Island, where all Iranian exports are pushed through. Those kinds of questions are needing answered in the next 24, 48 hours, I would say. I mean, and guys, feel free to chime in if you like. The next one is whether we can get ships flowing again through Hormuz. I think there's a lot of confidence that the Western powers can keep things open. And there's the other side of the argument that says Iran doesn't need to do much to make life difficult, right? So even if you take out half of their mobile missile launchers and naval drones and stuff like that, it only takes a trickle of attacks on vessels to make life extremely difficult indeed. So I think there's some overconfidence about particularly in the short term, whether we can actually keep oil flowing very well.
Same goes with the Houthis as well. Very little.
Same goes with the Houthis. Yeah, exactly. And the last one, I suppose, just on that level is evidence of what crude procurement, how healthy is crude procurement, so to speak? Are we seeing any issues with Asian refiners' purchases of crude? And then we want to try to make some inferences about how impacted runs will be globally from this issue. I think that might be a story of the next 5 to 10 days, June, because there's still lots of oil in water. It's more of a crude landing in, let's say, April, May, June even. Is that a fair thing to say, June?
Yeah. Of course, I'm also thinking back from my scheduling manager days. For such a disruption, you've got, your programs are all messed up. Your refinery, your cargoes are going to come at, all different chunks of periods of time versus your original plan. The yields that you are expecting is not going to be what you expected as well. So it's really the prompt issue is affecting immediately. The forward, you still also have to buy crude for the forward month, the 2 months ahead purchasing window, which is going to come in the next 1-2 weeks. Got to make decisions on buying WTI right now, which I think many refiners will want to do already, given the situation. Supply diversification is now going to be a big theme. Yeah, so many moving parts.
Yeah. I mean, the priorities have shifted. It's no longer about yield optimization, but just security of supply. And you'll take the cargo that is there when it's available. And I would assume that, obviously people will be looking at ARBs and efficiency of ARBs, but then it's more about security of supply. Because even if you do have, let's say, a crude that is loading out of Fujairah, then how do you know if it's going to be loading on time, first of all?
Exactly.
And so you don't want to take those risks necessarily. So, but again, that's more for the future, as Neil was saying. But Neil, you touched upon oil on water. And I've had many questions, people saying, but what about all of the oil that was on water and the supposed oil gluts and all that? Isn't that going to be helping the situation? Is that why we're seeing flat price not going further than 78? Or what do you guys think?
I don't necessarily know if I can answer the lack of flat price upside in that context, but the oil glut story, I think we should largely ignore just now. There's always a lot of oil and water from purely the perspective of ton miles having been very large. Ton miles have risen because there's more Brazilian going to China. Ton miles have risen because there has been more AG supply in the market, and so on and so forth. It's not just oil that's been sitting there unused. Let's put it in very simple terms. And the thing is, let's say in the upper end of the forecasts for this oil glut are 2, 3, 4 million barrels per day long. It just pales in comparison in terms of the size of the potential problem in the AG. How much oil is flowing through the Strait of Hormuz? 10, 15, 20 million barrels per day, depending on how you want to think about diversions and all this kind of stuff. So the size of the problem is just much, much greater. So I think we basically just have to ignore the oil glut in this context.
Okay. Well, guys, we'll be monitoring the situation. We, of course, as events unfold, we might have an additional extraordinary podcast to talk about the new events and how is that impacting the market. We'll keep a close eye on how freight is doing, because obviously that is impacting the rest of the crude and products market. But as I said, we do this with tremendous amount of humility. No one really has a crystal ball. No one really knows what will happen. This was to a certain extent expected, but unexpected at the same time, because no one really thought something like this could happen, even though there were talks about it and all that.
Indeed.
So we'll keep you posted, guys. And thanks a lot for listening. And thank you guys for your insight today.
Thank you too.
Thanks.
Thank you.
Thank you.